Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today, we want to focus on three key aspects that we think is really going to drive the market over the next few weeks. One of them being the consumer, the other is going to be unemployment, and then obviously it's our favorite, the Primary Vision Frac Spread Count, as we look at what U.S. oil production is going to do. So let's just really jump right in and pick up at the U.S. Federal Reserve Bank of New York Economic Index. Now, this is something that was recently created, but it was backdated, so we get some really great information on more of a real-time basis. You know, where are we sitting? How are things doing? And here you can see that it's normal to see a recovery off the bottom, given how sharp and how fast everything really happened. But we need to consider, where is this going to kind of balance out? And you're starting to see, we're starting to get this little, waiver. You're getting some spits and starts in terms of economies turning back on, some things slowing, some concerns on COVID. So here's an index that I think is something that's key to watch. Imports have been slow. Exports have obviously been under pressure. We had Chinese imports down 16.7%, exports there down 3.3%. And again, these are numbers that, people, can you trust it? Can you not trust it? Even though, I would say that some of it is manipulated, it's still negative. And the fact that they're putting out a negative number is concerning. And when you think about, okay, well, what does it mean on a global level? That's when we can really hone in on the PMI heat map. And the reason why the heat map is so great, and it's something that, I think it's JP Morgan takes it from Bloomberg, puts some pretty colors on it, and you can get an indication of the last 2 years. When we go back to 2018, and this is why when we talk and when we write, we like to focus on what was 2019 into 2020. And you can see things were really slowing down. Like, you had some blips, you had some benefits, some things starting to get a little bit better into 2020. But again, for the most part, we were flat to down, and the railroad data, the export data really kind of drove that home, which is why we started getting bearish distillate back in about mid-June of last year. So when we look at this, you can see that the European zone, the US, like everything remains in a contractionary spiral. And just given where the global world sits, it's really hard to see how we're going to get a meaningful bounce coming out of that, or really a sustainable expansion. We can come off and not be at a PMI of 30. Instead, we'll be at a PMI of 45. So we're still contractionary, but really not at the same level due to the shock. There are key aspects that we're going to talk about that have to be watched to see if we kind of bounce and then come back down towards a 40 or 35. But the ones to really look at are in that top quartile, where we're looking at things on a holistic level based on what JP Morgan has put together, emerging markets and developed markets. Because the emerging markets is something that we remain very concerned in. Emerging markets, we have about $10 trillion of support on a global level, and the IMF is saying we're going to need a lot more. And those are things that we talked about in the special report we put out, because we think it's something that's going to be a big driver as we go forward. But now that we've looked at things on a global level, let's turn back to the U.S. and more specifically the U.S. consumer. We've beaten to death distillate and industrial, but let's look at the consumer, because the consumer has been really what got us out of the Great Recession, or the financial recession that we had in 08-09. And you can see that bankruptcies are on the rise. They're essentially right around the 2009, 2008 levels. And you might think, okay, well, 2009 was 07, 08, people were feeling pain. Why is it so high so fast? And the real answer is leverage. When we look at how total consumer credit has only gone up over the last, let's say 30 years, but we've really hit a new stride following the financial crash. So this is why there's going to be a bigger problem, especially as people go to either get new debt or roll that debt. Because even though rates remain low, the question is going to be, what are the standards in terms of issues? So when we look at credit cards, auto loans, and consumers, just in general, in terms of their ability to get debt and what is the credit quality required to get, let's just say the top quartile in terms of interest rates, you're starting to see that people are focusing more and more. And by people, I mean loan officers, banks, when it comes to issuing new debt. And these are things that are going to start to squeeze people, as their home equity line expires and they go to get a new one, it's not going to be the same as they have to replace a car, get new credit cards, or what is the loan on a credit card. You're going to start to see some tightness, or realistically less people getting the best deal possible. And that's going to start to eat away and start to erode some of the spending that has been, I'll call it frivolous over the last, 10 years or so. And when we look at, how is that being carried out in the market, you can see the US dollar volume. So clearly people were spending less, you're not going out. Your kids don't have swimming class, they don't have dance, they don't have, extracurricular activities. There are things that stopped, and you're seeing that, like that, things have normalized. But again, things came off so fast that you're going to get a nice bounce off the bottom, but we're still 20% off of where we should be, or where we came from. And that's a bigger thing, especially when we look at gas stations, because when we look at gas stations, you have to consider everyone's talking about, okay, things are getting better, people are driving, which is true. Things are getting better. People are driving, but they're not driving to the same ratio that they were previously. And that's why we look at Gas Buddy data, EIA data, as well as Apple and Google data, because they each signify a different quartile of who's driving, and at the same time, who has the most mobility. And you can see that when we look at the global the US landscape, you can see it's still very weak. But at the same time, people are feeling better. People are happy that lockdowns are ending. We're in phase 2 in New York. We're in phase 3 and 4 in other places. So you're starting to get people starting to feel better about the situation, which is why the Michigan index started to see that bounce and recovery. Does it go back to where it was? I'm going to say no. But at the same time, we could see a normalization at 90, 95 as people start to, look at what's going to happen going forward. But then that's when we start looking at employment and unemployment, which we'll talk about in a little bit. But again, retail traffic is up. So retail traffic is starting to shift for the positive. People are going through stores. It's really not converting into a huge amount of sales. But again, people are just getting out, starting to normalize. And we think that number now, while it won't go back to the original seasonal average, it'll still start to kind of continue to grind higher as more places come out of a lockdown. And, the headline maker today is the TSA checkpoint. Now that it's over 500,000 people, but again, it's very important to put it into perspective. Where were we last year? And you can see last year we were at 2.67 million people. And realistically, we should be trending up. Like if you think about, we're in summer vacation season. So as you can see from the top, with that white line, you can see that the troughs are getting shallower, the peaks are getting higher, because this is when we should see an increase. And the TSA, while a much lower number, is starting to show the same peaks and troughs. So we're going to continue to get that trend. We don't think we get to 1 million. We're comfortable saying that we're going to kind of remain between that 500 and 750,000. Just as people start to take a bit more risks, the question is, are you going to do it with a family, or are you going to do it because you're newlyweds or you're going out with friends? So you're still going to have a little bit of a slowdown, but it will get better. Now, now that we've looked at, retail, we've looked at travel, we really need to focus in again on gasoline. So gasoline, we talked about spending being down. We have month over month increases, but at the same time, we're still down about 20 to 21% year over year. And that's going to be a big focus as we go forward, because, are we going to get back to normal? And, as we've been saying, the answer is going to be no, but we are going to normalize. And I think it's between that, down 15 to 20% year over year. So we're starting to see kind of this flatlining, especially as COVID becomes a bit more of an issue in some other places, which we'll touch on in a few moments. Now that we've talked about some specific data points across the consumer, we really have to consider what's happening in the employment world. Because the one thing that we've continued to see and that we've been really talking about is that continuing jobless claims is going to be a huge overhang. Now, it was supposed to come down. It was supposed to be about 2 million. It actually came in at about 2.1 million continuing claims. And the reason why this is going to cause pressure is because as people stay on unemployment longer, they start to get more and more desperate, especially as I think it's in July, we're supposed to lose the additional bump. It could get extended, obviously, but it's something where people are going to start to say, okay, well, what do I have to accept to get a job? And this is when you start seeing people shift down and that underemployment start to increase. So jobless claims, specifically on a continuing level, is going to be a huge overhang as we go forward, and which is why we think we're going to kind of settle at something that's probably closer to 20% below that seasonal norm that we should see across normal spending habits, especially as we go into the summer months. And the reason why we think that's going to be the case is, you really have to compare the Great Recession, or that, when we think about 07 through 09 and then COVID, you can see that the shocks are very specific. The search shock is one thing. We know that there's going to be, there's a timing. People aren't in the office. Like, you can't really get, an interview, or if you do, it's on something that I'm talking to you on right now. And when you look at the reallocation shock, these are things that are very consistent. It's the demand and supply shock. The issue is you're going to have less supply coming back. Like, is that hotel coming back? Is the retail store? Is the mall? These are things that have a reverberating effect throughout that local economy in terms of restaurants and other things that are going to come along with it. And this is why there's going to be a lot of stickiness to where does this go as we kind of try to come out of, the COVID slump, which, as we showed, was already struggling. I mean, we already had 9,800 retail bankruptcies last year, and we could easily double that already and probably end the year closer to 20 to 25,000. And that's why the high earning jobs becomes a problem. And by high earning, I'm talking about executive, mid-level executive. You're not just losing some hourly workers at hotels. You're losing general managers. You're losing people that have healthy salaries, which is really where people spend their money. From that consumer side is really that mid-level. And if you can't get another job that's 250, 300,000, are you willing to move to another place and accept 150? And as we all know from Powell, he's looking to keep asset prices inflated. So you're not going to get the deflation on that side. So you're going to accept a lower wage, but your cost of living isn't really going to adjust. And you're seeing that, leisure and hospitality is going to be the biggest kind of focus in terms of what can be lost and what's going to continue to be lost as some of these fiscal stimulus starts to run out. Loans start to come due, and you start to get, businesses looking past fiscal stimulus and some of these loans and say, okay, well, what is our normal business going to look like going forward? And that's where we're starting to see this right sizing. Now, this is going to be a lot of pressure, and that's one of the reasons why we kind of like that Apple data, because even though Apple only accounts for 13% of the market, typically in terms of who owns an iPhone, it's someone that's going to fall in this quartile. And that's why it's going to be interesting to see as these people start to lose their jobs or get less confident with their jobs, is that going to be reflected in the Apple data? And that's something that we're going to start to look at correlations for. And now, the one thing that, we were very aggressive with COVID back in January and February as being a real issue. And the one thing that we continue to look at when we're looking at our exports, whether it be diesel, gasoline, oil, the new cases continue to rise. And now, while this isn't a big issue for some states that we've spoken about, it's going to be an issue for our exports. It's going to be an issue for imports in terms of, where does this product originate? And this is as we go into, the summer, traveling, barbecues and others, is there going to be a chance of a reinfection or a resurgence? And that's why we have to look at, what's happening in the US. Now, from the very beginning, I was a person who was talking more about ICU capacity, because intensive care units is how a hospital is going to function. When you have an elective surgery, an emergency surgery, if you have some terrible, horrific accident, you're going to need ICUs. And this is why you need to make sure that there's always availability for the accident, for the emergency surgery. And you're starting to see some of this run tight. Now, we've learned a lot throughout our COVID experience. We are treating them better, in terms of putting them right on a ventilator, flipping them on their stomachs, using CPAP, which is just forced air, doing things to help alleviate the need for extensive ICU care, because the average COVID patient in a hospital can be there for an average of 12 days. So it's a huge onerous nature on just the supply chain, specifically the actual hospitals. And this is why we need to focus on ICUs, because if we continue to see an increase, but ICU availability stays here, then it's not the same type of problem. But this is something that is always going to be a focus for us, especially as countries and states start to reopen. What is the infection rate looking like and how are hospitalizations running? Now that we've gone through some key economic indicators that really drive the consumer, looked at what's happening in unemployment, it's now time for our favorite segment, the primary vision frac spread count. So the primary vision frac spread count came in at 69 today, which is about a 19% or almost 20% increase week over week. Now, that really can't be lost in terms of how big that is and what's really driving that. So right now, what's been driving it the most has really been the gas plays. The more importantly, Appalachia, and on a slowing or speeding up level, the Haynesville. So here we also have the DJ and Bakken that are starting to experiencing some growth, week over week, and they've been slowly kind of grinding up, but they're starting to see more work come back, which isn't that surprising given what we've been discussing in terms of shut-ins coming back online in both the Bakken and the Permian. Now, the Permian, on the other hand, has kind of hit that bottom. We think that we're going to kind of level off. But the question is going to be, where is this going to go going forward? So you can see from this chart, we've gone from that low of 45, we kind of held 45, and now we're back to 69. The question is, where do we go from here? And just given where crude prices are, where the curve sits, and how nat gas has really been struggling to kind of find a footing, it's going to be hard to see additional growth here. And so can we get to 75? Sure. Like 75 is definitely in play, especially as some of these oil spreads come back. But then the question is going to be, where does gas go from here? And it's going to be hard to see gas maintain some of these levels, especially as just the curve isn't very responsive. And one thing that we're also going to talk about more next week is chemicals. And the reason why, mentioning chemicals is because NGLs, or natural gas liquids, is a big component of some of these specific plays. And we're getting a lot of commentary, and it's actually appearing in some of the numbers now, that Conway is seeing some weaker pricing, which is then pushing back and creating realized prices at the wellhead that are well below what we're thinking should be normal in the market. So you're going to see headwinds, not just on natural gas, but also on those NGLs that is really pivotal. So, before we sign off, we really have to just understand where we were a year ago. And a year ago, we were at 400. We got down to last week at 58 and now at 69. So you can see how precipitous this drop was and how quick it actually happened. And it's just the move down is going to be, as they always say, elevator down, escalator up. This is going to be one of those slow grinds back up. And then we're probably going to level off just because pricing remains on the other side of where we should be. And just, what's happening with OPEC, as we've continued to discuss, how OPEC is still maintaining, elevated supply for where demand is. So there's going to be a lot of headwinds to look at, but we're always looking at those leading indicators, lagging indicators to see what things happened, what happened in the past, and kind of project what's going to happen in the future using some of these leading economic indicators and our tracking of different boats and refined products. So before we go, we should really talk about what's happening in the DJ, and we have the anti-frac starting to pick back up. Now, it's not something that we think is going to be a big problem, but it's always something to keep an eye on as we go into a pivotal election year. So next week, we're excited to come to you again with the EIA report. We're going to focus a little bit more on chemicals, just to kind of look at another area that is a huge buyer of not only just oil, but also natural gas and natural gas liquids. And then we're going to wrap up on Friday with some key economic data, some COVID updates, see if anything has changed. And then obviously our favorite topic, the primary vision frac spread count. So again, thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Thanks again.